China isn't just building factories anymore. It's building leverage. Leverage over supply chains. Leverage over trade routes. Leverage over critical minerals. And increasingly, leverage inside the global financial system. Its economy is worth nearly $18 trillion. But the size isn't the real story. The real story is the direction. Because while Western markets focus on quarterly earnings, election cycles, and short-term volatility, China has been executing a long-term economic strategy that stretches across decades. And if that strategy continues to unfold the way it has over the last 10 years, the ripple effects won't stay inside Asia. They will show up in U.S. bond yields, in European manufacturing margins, in commodity pricing, and eventually in your investment portfolio.
So before we go deeper, if you value calm, data-driven analysis without the hype, take a second to like this video and subscribe. It tells the algorithm you want serious macro breakdowns, and it helps this channel grow. Now here's what most people get wrong. China is not trying to replace the United States tomorrow. It's not attempting a dramatic financial revolution. It's reducing dependence. For more than 70 years, the global financial system has revolved around one central pillar, the US dollar. Oil contracts are priced in dollars. International debt is issued in dollars. Central banks hold reserves primarily in dollars. Global commodities settle in dollars. That structure created enormous advantages for Western markets. Consistent global demand for dollar assets supports treasury markets. Treasury markets anchor global liquidity. Liquidity supports asset prices. It's a reinforcing cycle. But financial dominance is not a law of nature.
It's a structure. And structures evolve. China understands that challenging the dollar directly would be unrealistic. So instead of attacking the center, it has been building alternatives around the edges. Over the last decade, China has signed currency swap agreements with trading partners. It has expanded cross-border settlement in its own currency. It has invested heavily in infrastructure across Asia, Africa, and Latin America. It has gradually reduced portions of its U.S. Treasury holdings from previous peaks while increasing gold reserves and strengthening regional trade partnerships. None of these moves collapse the dollar system overnight. But that's exactly why they're powerful. Financial dominance rarely breaks loudly. It erodes quietly. Erosion doesn't show up in a single headline. It shows up in reserve composition, in bond demand, in settlement choices, in who sets financing terms.
And when erosion compounds over years, the adjustment phase can be sudden. That's the part markets struggle with. Now pause for a second, because this is where most investors misunderstand the moment we're in. They assume dominance is permanent because it has always existed in their lifetime. But if you look at reserve currency history, no system has remained unchallenged forever. Not because it failed in one dramatic collapse, but because alternatives matured quietly in the background. By the time the shift became visible, capital had already repositioned. That's why timing matters more than headlines. Now let's break down the mechanics. If even a small percentage of global trade gradually shifts away from dollar settlement, global demand for dollar reserves adjusts. When reserve demand adjusts, demand for U.S. Treasuries adjusts. When Treasury demand adjusts, borrowing costs respond. That's not political commentary. That's basic capital flow math.
The United States still benefits from deep liquid capital markets. The dollar still accounts for the largest share of global foreign exchange reserves. Those advantages are real. But reserve dominance is proportional. Even small percentage shifts matter when you're talking about trillions of dollars. Now, layer in supply chains. China dominates processing capacity for many rare earth elements essential to advanced electronics, renewable energy systems, and defense technologies. It has secured long-term energy relationships across multiple regions. Through infrastructure initiatives, it has strengthened trade corridors that bypass traditional Western intermediaries. Supply chain concentration equals pricing power. Pricing power influences inflation dynamics. Inflation dynamics influence central bank decisions. Central bank decisions influence bond markets. Bond markets influence everything from mortgage rates to equity valuations.
The system is interconnected, so when China strengthens control over critical nodes in the supply chain,
Western markets feel it indirectly, not immediately, but structurally. Now zoom back to capital markets. For decades, global savings flowed heavily into U.S. assets because there were few alternatives with similar depth and stability. That advantage remains significant. But alternatives are expanding. Emerging markets are developing deeper capital markets. Regional trade blocs are increasing internal settlement. Technological ecosystems are becoming more distributed. This is not a zero-sum story. It's a distribution story. If global capital becomes more distributed, automatic advantages become conditional, and conditional systems are more sensitive to shocks. If global trade becomes less dollar-centered over the next decade, Western governments will face a different financial environment than the one they're used to. Deficits will matter more.
Interest costs will react faster. Policy mistakes will be punished more quickly by markets. And that doesn't require collapse. It requires competition. Competition for capital. Competition for credibility. Competition for growth leadership. And competition changes behavior. Now let's make this personal. If capital allocation becomes more geographically balanced, investment returns may become more geographically balanced as well. The era where U.S. equities consistently outperform all other major regions may not repeat in the same way. Interest rates could remain structurally sensitive to global capital competition. Currency volatility could increase. Sector leadership could rotate toward regions aligned with emerging supply chain strength. This does not mean abandoning Western markets. It means adjusting expectations. The world is not ending, but it is evolving, and evolution changes incentives.
China's $18 trillion economy gives it scale. Its strategic planning horizon gives it patience. Its diversification efforts give it optionality. Optionality is power in uncertain systems. Here's the deeper truth. The question isn't whether China replaces the West. The real question is whether the West adapts fast enough in a world where financial power is no longer automatic. Because when automatic advantages fade, only two things remain: productivity, discipline. And markets reward both, brutally. This isn't about fear. It's about awareness. Structural shifts don't ask for permission. They unfold gradually, then visibly.
If this breakdown helped you see the bigger picture more clearly, share it with someone who follows markets but hasn't looked at global strategy this way. And I'd genuinely like to hear your view. Do you see China's moves as normal economic diversification or as a deeper long-term challenge to Western financial dominance? Drop your thoughts in the comments. I read them. In the next video, we'll break down how reserve currencies actually lose share over time, not dramatically, but mathematically, and what early indicators signal when shifts accelerate. Thanks for watching. Stay informed, stay rational, and I'll see you in the next one.